Time for my favorite content. Let's go through the Bank of America flow show. The winners of the month were Nvidia and the big 7 monopoly tech companies. Losers were Bitcoin, regional banks, and China. The AI baby bubble is dominant. China is bared up by a stalled reopening and capital isolation theme. Tech took us from 3,800 to 4,200. To go further, Bank of America says we need something else to catch on. The tale of the tape is that tech stocks have discounted a June Fed pause. Meanwhile, a China stimulus and a bullish June surprise would be a further catalyst. The contrarian trade for June would be to buy the Hong Kong Stock Exchange and sell AI. They want to hedge with some beaten up commodities, emerging markets, resources, and banks. Global liquidity was up $9 trillion in 2020, $4 trillion in 2021, and a bearish $1 trillion in 2022. In 2023, a lot of people talk about the Fed tightening, but we're actually stimulating a little bit. This is set to collapse $1 trillion in the next 3 to 4 months. They call it a Q3 bearish story, especially if Fed hikes resume. The big picture is the NASDAQ is at an all-time high versus the Russell. You can see that here. Monopolistic tech with pricing power is squeezing competitors and winning. The market is bored of waiting for rates to cause a recession. So there's a flight to quality. Again, this NASDAQ 100 versus Russell spread is the highest since March 2000. As for flows, $15 billion finally went into equities, $11 billion piled up in cash again, $1 billion went into bonds, and $200 million came from gold. This is the 6th week of cash inflows, on pace for $389 billion in the Q2 of 2023. Stock saw its largest inflow since February 2023. Tech saw its biggest inflow on record at $8.5 billion. Consumer stocks saw their largest outflow since October 2022 with $600 million. They said the 12th straight week of equity outflows, but that doesn't make sense. They just said that flows were into stocks. And the 20th straight week of bond inflows. BofA private clients are buying Japan and value ETFs, selling energy, loans, and tips. AUM of the big 7 monopolistic tech companies are up 44% year to date, but private clients have sold the rip. Still, at 31% of equity AUM, that's higher than the 28% in the S&P, so they're overweight big 7. Again, they talk about stock inflows, so they did have inflows this week. And BofA remains bearish and wrong. Investors have no mood to fade their 4,200 SPX target. They still think that the biggest pain trade over the next 12 months is Fed 6%, not 3% on the funds rate. And that less than 3% would require greater than 4% unemployment. They believe that a summer rip would tighten financial conditions with a sneaky strong US dollar. They also believe that a 220 earnings per share for the S&P at 20 times price to earnings ratio plus 150 basis points in rate cuts won't add up. The biggest question is what will make the stock market go down. There's no catalyst, the market says. That often precedes an immediate top. Bank of America responds. Sell in May, Bank of America says worked. The NASDAQ 6%, Nikkei 5%, US dollar up 3%, and SPX flat. I disagree. Gold was down, government bonds were down, and crypto was down. Oil was down the most. They say that it was a tough May for most asset classes besides tech. Strong payroll report today, and bonds trading well for the one day in June, points to a Goldilocks outcome. Meanwhile, a weak payroll and a bond sell-off would lead to a stagflation thesis. US tech wins when growth is scarce and rates are falling. The Eurozone and Japan, which are made up of industrials and consumer discretionary, win when global PMIs are on the rise and the dollar is appreciating. Emerging markets win when tech looks bubbly, and when EMFX is appreciating, allowing lower rates to boost banks. Again, positioning is happily long credit and now chasing a summer riptide into tech and stocks. As far as profits, the weakness in growth is led by manufacturing and banking. Last year's worst sector, housing, is showing stability. The labor market is a lagging indicator, but remains strong in a post-COVID world driven by hoarding, low participation, and immigration. The big fiscal stimulus is set to phase in the second half of this year, but no recession until ultra low 3.5% unemployment starts to rise. BofA's global EPS model remains very negative, consistent with global PMIs, financial conditions, and Asian exports, as well as the yield curve. Once the consensus has given up on a recession, count on it, they say. This supports the fact that most economists are usually wrong about recessions. Monetary policy remains the big risk and is set to tighten in the coming months. This is the biggest risk they're not capitulating on their bearish thesis. Again, $1 trillion of quantitative tightening is coming over the next 3 to 4 months. This is comprised of $100 billion from the Fed, ECB, Bank of England, Bank of China, Royal Bank of Australia, and Royal Bank of New Zealand per month, plus another $1 trillion in T-bill supply, plus a $200 to $300 billion rise in Treasury General Account and money market outflows would equal a $1.5 trillion liquidity drain. And they expect that a June Fed pause is only temporary. In this market, the biggest companies have the biggest profit margins and therefore the biggest price earnings ratios. Megacap tech has a 4 times bigger profit margin than the smallest 55 companies in the S&P 500, which are trading at a 14 PE versus a 32 PE. Those big 7 monopolistic tech companies have comprised of 8.8 percentage points of the 10 percentage point year-to-date return in the S&P 500. The S&P 493 have only returned 2.5%. Those big 7 are at an all-time high in terms of percentage of market share, even though the 10-year is at 3.8% versus 1.5% when it was last there. S&P as a whole is trading at a 19 PE, but that is comprised of the big 7, which is trading at a 30 PE, and the rest, the 493, are trading at a 16 PE. The NASDAQ 100 are also at highs versus the Hang Seng Hong Kong Stock Exchange. This is why Bank of America is saying buy Baba, Jadu, Baidu, and sell Microsoft, Nvidia. I say own them all. Payrolls and the Producer Manufacturing Index have diverged recently. They usually stay together. Bank of America is calling for payrolls to come down, not for the manufacturing index to go up. As far as compositions go, the US is dominated by tech and healthcare. And as I said, Japan and the Eurozone are dominated by industrials and consumer discretionary. Meanwhile, the UK, Canada, and Australia are dominated by financials, materials, and energy. Emerging markets have a lot of financials. And because of Korea and Singapore, a decent amount of tech. Bank of America's earnings projections remain negative, but they've been wrong for 3 quarters. They cite Korean exports as a leading indicator, falling negative in 2023. A big reason why the stock market's been up this year is because global liquidity has been ample. But again, this is set to collapse by $1 trillion over the next 3 to 4 months. Meanwhile, monthly inflows to tech at $15 billion are nearly hitting February 2021 levels. This is cause for concern. The weekly tech inflow actually broke a record at $10 billion. At least we're breaking records. Flows have been into Japan and out of energy. And the S&P has taken the top spot in terms of asset classes this year, with gold falling to second and Europe falling to third. Lastly, the bull-bear indicator remains on the buy side, and this has been their most accurate indicator. They nailed the October 22 and June 22 local lows and the top in February 2021. If you like this kind of content, give me a follow if you haven't already. A like would be appreciated, and share this to a friend that might enjoy it. I do this because not everyone gets access to this type of content. You usually have to be a Bank of America or Merrill Lynch wealth management client, and everyone deserves to know what's going on. If you want the full report, add me on LinkedIn, it's there.